This episode of MiningStockEducation.com is brought to you by Sandstorm Gold Royalties. Sandstorm Gold Royalties is a different kind of gold company. They purchase royalties on select mining operations and receive a percentage of the revenue in return. Sandstorm now has a portfolio of nearly 190 gold royalties around the world. See how gold royalties differ from other gold mining investments at sandstormgold.com. That's sandstormgold.com. Sandstorm Gold Royalties trades on the TSX as SSL and on the NYSE American as SAND. Thank you for tuning in, ladies and gentlemen. I'm Bill Powers, your host with Mining Stock Education, and joining me on the line today is my friend Dave Kranzler of Investment Research Dynamics, and he is also the editor of the Mining Stock Journal. We're touching base with Dave to get his thoughts on the recent action in gold this week that has many junior mining investors encouraged, and to get his overall thoughts on the sector. So Dave, thanks for coming on the program.
Thanks for having me on again, Bill. It's my favorite subject to talk about, so hopefully I won't drone on too long.
Well, today it's the markets have closed on Friday as we speak, as we're recording this. Yesterday, as you know, gold saw a $30 gain, and there's a lot of hope that's arising with many of the things that I've seen written comments online. Would you say that this is the bottom? Is this the beginning of the rally we've been waiting for?
Well, that's actually a good question. Every time I try to pick a bottom, I'm always wrong. And, I told myself 10 years ago that I was going to stop doing forecasts, but I actually, in mid to late December, I actually thought that was a bottom, and I came out on record, especially in my mining stock journal, pretty adamant that was a bottom. So, the market ran up really quickly back then. I mean, the gold bulls, including myself, we were just after the previous 4 plus years, we were so ready for the market to turn around. I think everyone just kind of jumped into it. I think the hedge fund algos exacerbated the problem. So what we've gone through for the last, a little bit more than a year, maybe a year and a half, is not an unreasonable consolidation pullback from that. I mean, we had a quick run up from the end of December 2015 to like the middle of 2016. I kind of looked at that and I'm like, well, I hope this lasts, but I can see where this could pull back and people are going to be despondent again, and that's kind of what's happened. But I guess I would say I think that. And again, I'm going to put a wide range on this just because the market's so volatile and manipulated. I think we have seen the absolute bottom. That doesn't necessarily mean that it's, the gold won't test sort of the 1180 to 1200 area again, which is what it seems to be doing. I think it was 2 issues ago, maybe 3 issues ago in my mining stock journal, I outlined why I thought that the 1215 to 1220 area was going to be a key area to get through. And that was based on, if you look at when the hedge funds started building their enormous net short position in COMEX gold contracts, I kind of eyeballed what I thought was the average cost of that net short position, not necessarily their outright short position, but just from the time they went from being net long to flat to when they started going net short COMEX gold contracts. I kind of figure that their net cost of that net short entry is somewhere in the 1215 to 1220 area. If you look at a chart, gold for, probably for about 2.5 months or so. Again, I don't have the chart in front of me, so it's just from memory. Gold would bang its head on kind of the 1215 area, and then it would sell off and go down to the 1180, 1190 to 1200 area. So, and what I said in that issue where I suggested where the key line of resistance is that if some event can cause gold to shoot through, especially, COMEX led by COMEX paper gold, because that seems to lead the market. I thought if some event would cause it to shoot through that level, and if it held there for a few days or, a week or whatever, that we might actually see a massive short cover rally because, the hedge fund, the managed money account on the commitment of traders report, it's primarily hedge funds, and most of their trading is dictated by black box computer algos. So if it gets to a point where they're starting to feel pain on their net short position, they're gonna run to cover it, and then they'll swing back to being net long, right? Because their programs are momentum based. So, again, I don't know if we're going to hold above that level right now. I mean, what kind of shocked me, I know you wanted to get to the latest commitment of traders report. What kind of shocked me was I expected to see the managed money, well, I'll just call it the hedge fund. I thought that they would have started to cover their net short position, either by adding more long positions or a combination of adding to their long position and partially liquidating their short position. And actually, their net short position increased by over 27,000 contracts, and this is through
Tuesday, right?
Tuesday, right?
So that's pre the run up in gold.
It's the day before it spiked higher, and I'll get to that in a second. But I mean, I almost fell off my chair because I expected to see, the opposite. And when I first looked at it, I'm like, wait a minute, and I had to rub my eyes. I'm like, wow. So I mean, their net short, like, I mean, normally over the last 15 years or so, this type of net short positioning is what we would expect to see from the banks, not the hedge funds. And the banks, and it was primarily the commercials, took most of the other side of that trade. So the commercial category of COMEX trader got even net longer. So, and I would have thought that on Wednesday and yesterday, I would have thought that the hedge funds would have covered their, would have bought contracts to cover their short position. But if you look at the numbers through yesterday, and the numbers for today won't be out until Monday in terms, the daily numbers for open interest on the COMEX. But if you look at the numbers through yesterday, the open interest through yesterday was, I think it was 18,000 contracts higher than it was when the commitment of traders report comes out. And we don't know for sure, but what I think that means, and we'll get a peek at it a week from now when we see the COT numbers through next Tuesday. What it suggests to me is that the hedge funds were actually shorting contracts yesterday, defending their position, and Wednesday.
Yeah, I was going to ask you that. Do you think that we had a short cover rally combined with the flight to a safe haven because of the general equity sell-off Thursday? Those were the two main drivers.
I don't know, I don't know how I'd allocate the attribution between flight to safety and short covering. I would have thought that the managed money, the hedge funds were in there covering their shorts on Wednesday and Thursday. But the COMEX open interest numbers, because the open interest expanded by so much between Tuesday's close and yesterday's close, it means that someone was out there shorting paper. So maybe the hedge funds were covering their shorts, and the banks were unloading their longs, but they'd also someone had to short more paper, right? Because that's how the open interest expands. If it was just a function of the banks selling their long position to the hedge funds, then the open interest would have shrunk. Mm-hmm. So I have to believe that it was the hedge funds out there defending their short position. And that's, I mean, I traded on Wall Street for over 9 years in the 90s. And when you're a trader and you're running a big position and the market's going against you, the first thing you try to do, if you still feel a strong conviction for why you have that position on, whether it's long or short, is you defend it by if you're long, you keep buying it if the market's going lower and people are selling, or if you're short, you short more into it as the market goes higher. So, that's the mentality that hedge funds have. So I think for now, I think they're defending their position and they may try to push it lower. So again, we could see the price of gold ping pong back down to 1,200, but it's going to get to be more difficult for them because India is starting to wade back into the market. They had there was some extreme financial systemic distress over there. Their currency was getting clobbered, and the financial system was suffering some liquidity issues, and so they were. It made the conditions for gold importing uneconomic for them, but that's slowly shifted over the last week. And I know, based on the numbers that I saw for India for what would be their Friday, it looks like they were back to importing a fair amount of gold last night, and China too. China's now back in the market, and if you just go by the number of deliveries into the Shanghai Gold Exchange, that's a number that's reported on a daily basis. They stepped up their gold buying this week, and these guys buy physical gold that has to be delivered. So it puts a strong bid under the market, and it makes it harder to short the market with COMEX paper. So it's going to be interesting to see how this unfolds over the next several weeks.
Today, gold, after the run-up yesterday, was down about $6.50 an ounce to $12.17, and silver, though, was up about 2 cents to $14.58 an ounce. So it seems like silver might have been going up on industrial demand. Do you have any thoughts on that?
I wouldn't. I mean, on a day-to-day basis, it's impossible to know exactly what's driving the market. I mean, the dollar was up quite a bit today. And I'm sure after the big run gold had earlier this week, I'm sure there was some profit taking in there. I mean, the gold silver ratio has been kind of holding in the low 80s area, and that's what I like to watch to try and judge what's going on with silver. I mean, it's impossible to know if it's industrial demand or if it's the monetary metal attributes of silver. And again, to the extent that gold is manipulated, silver is even more highly manipulated because it's an easier market to manipulate. It's a fraction of the size of the gold market, and so it makes it easier to push around. In terms of what might have driven the price of silver today, yeah, there was probably some correlation effect there. A lot of times, what'll happen is if the stock market's up a lot, the hedge fund algos all automatically buy assets that are correlated with rising stocks. So the thinking behind that is, oh, the stock market's higher, the economy must be doing okay, so we'll get a little bit longer, or we'll buy some silver here because maybe that means there's going to be some industrial production, but some industrial demand. But again, I think a lot of that is just the narrative that the financial media likes to drop out there to try and explain day to day what goes on in the markets. And to me, that's silly because economic trends don't go up and down with the financial markets.
One of the things I try to look for after we get a big run-up day like we had on Thursday in gold is what do the juniors do the day after, especially if gold pulls back like it did today when it was down $6.50 an ounce. And one company, Gold Resource Corporation, a mid-tier producer, they're still up 4% today, even though gold is down. So, and that's a liquid company. It's trading around $5.74 a share, and they had almost 670,000 shares traded, which is not quite double their daily volume, but it's close to that. And to me, that's just an indicator that Thursday did something psychologically for junior mining gold investors.
Yeah, I mean, and that's borne out by the sentiment numbers. I get it's a market report that's put out 3 times a day by a guy named John Brimlow, and we get it because it helps us manage our fund. And it also contains a lot of information that isn't generally available, at least for free, on the internet or from the media. So I mean, so that's where I see my data on the Indian market is in his report. And one of the things that he publishes in there is daily sentiment numbers from Market Vein on gold and silver, and the Holbert Gold Stock Newsletter Index, which is published daily. And so, yesterday it had been running negative for a couple weeks up until early this week, and yesterday it actually had a pretty big jump in it, and that reflects that has a pretty close correlation with retail sentiment in the market, and it's mainly the retail investors that play the juniors, right? So. I'm looking at Goro now. It had a nice day today. It was up almost 4%.
And many of the less liquid juniors were up between 5 and 10% today, as I just scrolled through my finance app.
Yeah, I'm looking at my watch list that I keep for stocks that I feature in my mining stock journal, and also for that we have in our fund. And I'd say half the stocks are green, and you're right. Some of them are up 10, 11%. We had some stocks yesterday that were up over 20%. So I think that partially reflects short covering, but that's probably about 20 to 30% of the move that the juniors had yesterday. But it also, I think, reflects optimism toward the market.
I'm interested to get your feedback on the feedback you got from your subscribers and the average investor in the junior mining sector over the last 6 months with the pain that many of us endured in our portfolios. What type of feedback did you get over the last 6 months?
It's interesting because, I started the Mining Stock Journal in March of 2016, and I bet close to 25 to 30% of my subscribers are subscribers who signed up in the first 6 months, which to me was kind of shocking because I thought I'd have a much higher churn rate. And my subscriber base is obviously it's down from where it peaked in late 2016, but it's not down nearly as much as I would have thought it would have been, given what's happened to the market over the last 12 to 18 months. So I think my subscriber base tends to be sort of the harder core, strongly convicted precious metals investors. Now I get plenty of people who subscribe for a month and then cancel. So I don't have them. It's just the first month is the only minimum time commitment that I have with it. But most people, I think, kind of just batten down the hatches. And there's, I've had some that have been, especially in the last few months, are looking for ideas for bottom fishing. So, in the issue that I published last night, I titled it "Mining Stocks Have Not Been Cheaper in the Last 78 Years," and Incrementum had put out a chart. They published that they make it available to anyone. It's a great booklet of charts, and they also make their annual report available to the public for free. But I came across a chart in there that showed the Barron's. It's the Barron's Gold Mining Stock Index. The ratio of that index to the price of gold and to the S&P 500, and that index goes back to at least 1950. I had no idea it went back that far. And those two ratios, the Barron's Gold Mining Stock Index to gold and Barron's Gold Mining Stock Index to the S&P 500, that ratio has never been lower in the last 50 years. And so what I suggested was that, if you believe in this sector, now's the best time in the last 50 years to invest in mining stocks. Mm-hmm. So, and I kind of outlined, I started off by just saying, look, the large cap producing miners, like the Agnico Eagles, and Barrick and Goldcorp are different beasts altogether. I don't even really look at those stocks.
Barrick had a lot of insider buying the last few months.
Yeah, but I wouldn't go near Barrick. It's going to underperform the sector. I think Agnico Eagle's a much better player, or like a Kirkland Lake. But I just said, look, these stocks have been sold down to levels well below their intrinsic value, especially if you assume the price of gold holds at least at 1,200. I mean, these companies are making money at 1,200. Well, Barrick, I don't think is necessarily, but a lot of the producing companies have really streamlined their operations. They've cut their costs, and a lot of them can make money at 1,200 gold. Now that they still need to replace their reserves, and that's why Barrick. I'm certain that's why Barrick merged with Randgold. It needed to replace its reserves. Its reserves took a huge hit over the last year. And then I talk about the concept of the juniors, where I talk about optionality value, and that is, junior miners, they have either properties with mineralization that they've discovered, or some of them, or a lot of them have actual defined deposits. But you don't know if they're ever going to transform into being a producer. I mean, the odds are pretty low, but there's still optionality value there, and the market's been sold down so hard that the juniors are basically call options with almost no time premium left in them. There's stocks like U.S. Gold. U.S. Gold is trading below the value of it. It's got in addition to its exploration property, which could absolutely be a grand slam home run. It's got a property. It's a copper gold property in Wyoming that has a defined deposit on it, and they're drilling and expanding the size of the deposit, or potentially expanding the size of the deposit. And I know the company's been offered within the last 12 to 18 months, a price for that property that is greater than the current market cap of the stock. So, you're talking about a junior mining stock here where there's no option value in it anymore, and it's trading below intrinsic value. And to me, that's absurd. And that tells me that the market has gone to such an extreme in terms of valuation that, within reasonable bands of volatility, it's going to go a lot higher from here. So
the main risk on those type of stocks is their cash position and their burn rate. I met with a lot of pre-revenue late-stage developers when I went to the Beaver Creek conference last month, and that was something I was always interested in, is how much cash do you have? Because if gold doesn't rise like we desire, you could be diluted out of your portion of the company.
I agree with that, and we saw that issue really, really come to a head in the 2011 to 2015 pullback. I mean, there were periods of time during that 4 years when none of these mining stocks could raise money. What's interesting about that, though, right now, Bill, is that, and I of course, all the companies that I deal with and talk to, I ask them about this, and there's money that's available even now to invest in these companies. Companies that have reasonable projects, and especially companies with reasonable projects that have management with good track records, there's money there for they can raise money without a problem right now. And a lot of it's starting to come from private equity funds, because these private equity funds are probably, a lot of them are tapped out on technology companies that they can invest in, or the values have gotten, because of the stock bubble, have gotten so extreme. They're looking for other ways to put their money to work. And I've had a handful of companies tell me, at all the conferences, they get approached by private equity firms looking to invest. So I agree with you. The ability to raise money is something that you have to evaluate. But I think right now in this current environment, as long as you have a good quality asset and you have the potential to prove out a deposit, I don't think you have problems raising money, especially in areas where there's not a lot of, there's a lesser degree of political risk, like Canada or the United States or Mexico. Once you go beyond those areas, then you start to introduce varying degrees of political risk. West Africa too is an area where there's a lot of money being raised, and obviously Randgold, that's where their mines are, or it's West Africa. So, I mean, to me, the key feature of these junior mining stocks is that as these large producers like Barrick and Goldcorp, they need to replace their reserves because they're depleting them more quickly than they're finding them. And that's what's going to really increase the optionality value of these juniors. And a lot of the M&A activity that we've seen in the last 6 months has been in the junior sector.
A lot of that M&A I don't get excited about. I know some people do, but if you get a 40% premium when you're trading at a 52-week low.
I hate that too. I agree. I absolutely hate that. But you know what? I mean, what it does is that's why you have a diversified portfolio of juniors, because it increases the optionality value of all the other junior stocks in there, right?
Mm-hmm.
And we'll see at some point. We'll see at some point, especially assuming the price of gold, shoots back into the 1,500 to 2,000 range. You'll see crazy prices being paid for some of these juniors. I mean, it reminds me of when it was Newmont bought. It was a Nevada project, and the management went on to found Pilot Gold. It starts with an F. I always forget the name of it. Anyway, Newmont paid $2.2 billion for a 4 million ounce defined deposit, and that was everything, including the inferred. So we'll get back to the period of time when we start to see acquisitions at those price levels, because these big companies are going to get desperate for reserves.
Dave, one company you've covered in the past has been EMX Royalty. I'm curious as to your thoughts. They're about to receive $65 million from the sale of a gold copper property. Their market cap is right now about $100 million US. They have, of course, they're a prospect generator, and they have royalties. What's your perspective on that company right now?
You know what? I love EMX Royalties. They're based here just outside of Denver, and I know the management pretty well, and they're really good guys, and they're really bright guys, and they're great geologists. I think part of the problem with it, and they've got a great portfolio of projects, and I think part of the is with royalties, but a lot of these royalties don't necessarily, they're on projects. Like there's a massive copper project over in Serbia, but I don't know, it's probably 10 years away from becoming a mine. So you may have a big fat royalty on it, which they do, but the market's not going to give you credit for that until the mine actually starts to produce. And I think I think EMX is undervalued relative to its portfolio of assets. And as an example of that, it was trading at 70 cents before that deal to sell Malmish was made public. And as soon as that deal was made public, the stock jumped up to $1.20. So that gives you an idea of the embedded value of their assets. I think part of the problem with it is for whatever reason, I don't know, for whatever reason, the market doesn't seem to understand the nature of its assets, so it doesn't give it credit for the value of its royalties until they actually are, the royalties ready to start converting into a cash pay royalty. And they've got a really sweet, it's a gross smelter royalty on a large gold mine that Newmont has in Nevada, and I think they're undervalued just based on that royalty, because the footprint that royalty sits on, again, Newmont's been expanding the resource on that property, and the footprint that their royalty is based on keeps expanding, So I think if you want a low risk play should perform at least in line with the market, I think EMX is a good idea, but it's not going to be a 10 bagger. Frontier Gold was the name of that company that Newmont paid $2.2 billion for on 4 million ounces, and I think it was like in early 2011. So,
Rick Rule always says that the management that made those stupid transactions were repaid by losing their jobs, and gold miners today are much wiser and shrewd. But you foresee, if we get into that mania phase again, that human nature will repeat itself with these majors, huh?
if gold had if the gold price had stayed at 1800 or 1900, the prices paid for those juniors back then wouldn't look so stupid, right?
Mm-hmm.
I mean, it's easy with hindsight to take a shot and again, I'm always criticizing the management of these large companies like Newmont and Barrick, and it's easy to take a shot at them by saying, oh, they overpaid. Well, you know, I'm sure none of the upper management, these companies expected the gold price to go from 1900 down to 1100 or close to 1000, right? I mean, no one expected that, but that's what happened. So yeah, at $1,000 gold, paying what Newmont paid for Frontier looks stupid. But if gold goes back to 1900, it's going to look really bright. It's going to look like a great acquisition. And it's, a 4 million ounce resource that probably is going to become a lot larger. I mean, there's not many of those deposits left in the ground to be discovered.
Are there any junior miners that you follow as like a bellwether indicator of the direction of the junior gold and silver sector?
That's a good question. And, the juniors, I think the large cap mining stocks tend to move in a tighter correlation than the juniors do. And with the juniors, a lot of it is company specific. One company that I think that I recommend as a an early stage. When I say early stage, an early cycle, like if we're just starting the next move higher in the price of gold, we're early cycles. So if you're looking for companies that'll outperform in the early stage cycles, one that I think is a good one is Gold Standard Ventures, and that one was at $1.15 in as recently as mid-June, and it's up to it closed at $1.79 today. That's a pretty nice rate of return. I actually stuck it in the Mining Stock Journal at $1.20 back then, and I said, you know what, this thing's got an easy bounce up to the $1.70 or $1.80 level, and we own it in my fund, and it's a core hold, but we also trade it. We have a core holding, and then we put on positions when it sells off, and we think the market's going to bounce. We put on a position, and then we sell those shares we sell as the stock rallies. And the stock was actually at the beginning of September, it was at $1.45. So it's up, 35 cents roughly since early September. And that's a 24% return in 6 weeks, 5 weeks. Not too shabby. So to me, I like to use Gold Standard Venture as sort of a harbinger where I think the market's going to go. And it always seems to lead the market on the upside, and it seems to get hit ahead of downtrends in the market.
As we conclude, is there any advice you'd like to give listeners going into this last quarter, tax loss selling, or any other things we should be aware of?
If you've got names that you're sitting on that you think are hopeless and you've got a loss in them, don't be afraid to take the loss. I mean, one of the biggest mistakes that investors make at all levels, retail and institutional, is they don't like to take losses. You always hear them say, well, I'll sell it when I get my money back. Well, why would you do that if there's ideas out there that will move much more quickly than the loser you're sitting on? There's also opportunity cost, and the government lets you, gives you a slight benefit for taking losses, right? So, if you're sitting on positions that are underwater and you think the stocks are dogs and there's better ideas out there that you're looking at, sell them, take the tax loss and move the money into stocks that you think will perform better. And I think, again, there's still, the sentiment's still pretty negative toward the sector. And I think we saw the blood in the streets over the last few months. And so now is really the time to put money to work, or if you're still skeptical, at least, just sit tight and be right. And don't be afraid of the market. Well, I'd be afraid of the general stock market right now, but definitely not the precious metal sector.
And listeners, you can find Dave on the web at investmentresearchdynamics.com. And Dave, any information about the Mining Stock Journal you'd like to share with listeners?
Sure. It's, I publish it. It's every 2 weeks on Thursday. It's an email-based delivery newsletter. I've been told many times over the last couple of years that I'm offering it for too low a price, but you know what? It's. I think it's part of the reason why my subscribers stay with me, because I think I put ideas in here that will outperform the market. I've had several ideas, that were 10 baggers between the beginning of 2016 and actually some of them now are you're still sitting on 10 baggers from then. Silvercrest Metals is a good example of one. So I've had my warts, I've had my bruises on some of the names that I've picked out, but in general, I've had many more winners than I have losers, and that's what you got to expect in this sector. And I, as part of the subscription service, I do put out there, and it's not direct investment advice, but I give suggestions in terms of managing risk and managing your capital. So, and you can find the link to the Mining Stock Journal subscription on my website, investmentresearchdynamics.com.
I encourage you to go there and check it out. And Dave, thanks for chatting today. I appreciate it.
Thanks for having me, Bill. It's always a pleasure.
For millennia, ancient pharaohs prospered from unparalleled riches made possible by Egypt's resource-rich gold deposits. But despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. But that's all about to change. Aton Resources is leading the charge on the Egyptian mining revival. As the only public exploration company in Egypt, Aton Resources has first-mover advantage. Focused on their 100% owned Abu Marawat concession, Aton Resources is advancing several exploration targets, including the recent discovery of the legendary Lost Mountain of Gold at Rod Ruin. Learn more about this exciting drill program and other news at atonresources.com. Aton trades on the TSXV under the ticker symbol AAN and on the OTC under the ticker ANLBF. Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at MiningStockEducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more.